Hello everyone. In this particular recording, we are going to discuss inventory costing methods. In this chapter, the two costing methods that we're going to take a closer look at are number one, variable costing, and number two, absorption costing. All right, so variable costing basically is the costing method that follows the contribution margin format income statement that we looked at earlier in the course. Meaning we're going to take our sales and then we're going to subtract out all of our variable expenses. And then we get our contribution margin, and from there we'll subtract out our fixed expenses to get operating income. On the other hand, absorption costing is the method that we actually use for financial reporting purposes according to GAAP. Absorption costing is where we absorb the fixed overhead into the cost of goods sold. Effectively, the cost of goods sold is going to include both a variable and fixed overhead, and all the variable and fixed basically inventoriable costs. And then lastly, which is not used really at all, it's a third method called throughput costing, where with throughput costing, all we consider are the direct materials, and we actually don't consider the labor and the overhead when we're considering the margins. It's really not the greatest method to use at all, but I guess some corporations find usefulness in that. Okay, so because the big difference between variable costing and absorption costing is how fixed manufacturing overhead is treated, once again, with variable costing, fixed overhead is after the contribution margin calculation, but with absorption costing, the fixed overhead is absorbed into the inventory, if you will, and it follows the inventory through the sale. The cost of goods sold and obviously the operating income is going to be different period over period. The reason why the operating income is different with variable costing as opposed to absorption costing is the timing of when we sell the inventory versus when we produce it. If we sell and produce the inventory in the same exact period, well, variable and absorption costing are going to have the same operating income. But if we sell something, an amount different than what we produce, the absorption costing is going to be, the operating income is going to be higher or lower than the variable costing. So let's walk through these so you have an example. This is probably one of the more important slides in the entire presentation. So I'm going to take some time here, and you can see we have two sides to this Excel spreadsheet. On the left side we have variable costing, and on the right side we have absorption costing. I'm going to take you through line by line so you see how this works. We're going to start with variable costing. So you can see the first item, and by the way, these numbers are in your textbook. They are under the variable and absorption costing section in your textbook. The information is as follows. The selling price is $1,000 per unit. We sold 6,000 units. So if we take the revenues, $1,000 times 6,000 units, you can see that our revenue is $6 million for the period. Now with variable costing, what we are going to do is from the revenue, we're going to subtract out all of our variable expenses to calculate what's known as contribution margin. So first we're going to calculate cost of goods sold. And if you recall from your financial accounting class, cost of goods sold basically has a formula. And the formula is as follows. And this will probably ring a bell for some of you, hopefully all of you. Remember, the formula for cost of goods sold is as follows. Beginning inventory plus purchases, in this case, because we're a manufacturer, we'll say plus manufacturing costs, equals a subtotal, cost of goods available for sale. And from there, we will subtract out ending inventory, and we get cost of goods sold. In this example, once again, the data in your textbook, we are starting with a beginning inventory of 0. And now we're going to add manufacturing costs. The manufacturing costs are basically going to be the variable manufacturing costs. Remember, the 3 manufacturing costs are as follows: materials, labor, and overhead. Materials, labor, and overhead. Well, this $200, according to your textbook, is broken down as follows. The direct materials per unit is 110. The direct labor per unit is 40. And the manufacturing overhead per unit is 50. If you add up the 110 plus the 40 plus the 50, you get $200 per unit. And according to your textbook, we actually produced 8,000 units. So if we take the $200 times the 8,000 units, we will get $1.6 million. So beginning inventory of 0 plus additional manufacturing costs. Remember, materials, labor, overhead, 1.6 million gives us a subtotal, cost of goods available for sale. That's how much we possibly have available for sale. Now the question is, did we sell all of them? And the answer is no, we have some ending inventory. So even though we produced 1.6 million, we ended up with 2,000 units still in ending inventory according to the data in your textbook. So if we take the 2,000 units times the $200 that we calculated earlier, we subtract 400,000 from the 1.6, we will get variable cost of goods sold. Now, there are other non-inventoriable costs. There's basically the selling, general, administrative costs. Those are all the other variable costs. Your textbook flat out gave us the amount, $185 per unit sold. And remember, we sold how many units? 6,000. 185 times 6,000, that'll give us 1,110,000 plus the variable cost of goods sold, 1.2 million. Take these two numbers, subtract them from the revenue of 6 million, we get a subtotal called contribution margin. From the contribution margin, remember the formula, we're going to subtract out all of our fixed costs. In this case, we have 2. We have fixed manufacturing costs of $1,080,000, and we have fixed marketing costs. You subtract out your fixed costs from your contribution margin, you are left with operating income, $1,230,000. Now let's compare this to absorption costing. With absorption costing, this is required. I have to keep telling everyone the absorption costing is required for external financial reporting purposes. So when we are preparing a financial statement according to GAAP, an income statement according to GAAP, we are going to use absorption costing. Now remember, the big difference between variable costing and absorption costing is, number one, the format. We're going to calculate gross margin instead of contribution margin. That's number one. So the format is a little bit different. And number two, this fixed manufacturing cost of $1,080,000, it's actually broken down into 2 pieces. Basically, the $1,080,000 is broken down between, some of it is in the fixed manufacturing costs, okay, and some of it is in the ending inventory. And I'm going to explain how that works. Okay, so absorption costing. The revenue item you're going to see is exactly the same as with variable costing. We sold 6,000 units at $1,000 each, $6 million. That doesn't change regardless of our costing method. But the cost of goods sold calculation is a little different. The beginning, at least the numbers are different. The formula is the same, but the numbers are different. The beginning inventory is still 0. See 0 on both sides. And we're going to add in the variable manufacturing costs as we did over here in row 5 on the variable costing side. It's the same for absorption costing. So we're showing all the variable costs for the manufacturing. Remember, the $200 is broken down. 110 for the materials, 40 for the labor, 50 for the overhead. There's your $200 times the amount of units produced, 8,000 units. Now with absorption costing, remember, the whole idea is we are going to absorb all of the manufacturing cost, variable and fixed. So the fixed manufacturing costs of $1,080,000 that we saw down here in variable costing, way down here in cell C12, for the absorption costing, that's going to be part of it's going to be absorbed into the inventory. So we're first going to allocate all of it, the 8,000 units times 135. The $135, by the way, let me show you how to calculate this because this is extremely important. The $135 per unit is basically the $1,080,000 total divided by the 8,000 units. So we know the total. The author told us the $1,080,000. The author also told us the number of units produced. So if I take the $1,080,000 total fixed manufacturing costs divided by the number of units produced, 8,000, that's where we get the 135. That is important. So cost of goods sold, beginning inventory, plus all of our manufacturing costs, both a variable of 1.6 million and the fixed of 1,080,000, will give us a subtotal cost of goods available for sale less ending inventory. Now, do you see the amount of dollars that we apply to ending inventory is different for variable costing in cell B8 and in absorption costing cell F8. The reason why it's different is because of this reason. You see, with absorption costing, we are saying each inventory unit costs $335 per unit. But with variable costing, it was only $200. The reason for that, once again, is because with absorption costing, we are absorbing the fixed cost into the cost of the inventory. So effectively, the fixed costs are going to stay with the inventory throughout all of the processes. So first, it hangs out on the balance sheet as part of the inventory, and it doesn't become part of the cost of goods sold until we actually sell it. So as we said earlier, we have 2,000 units in ending inventory, but with absorption costing, because we're absorbing the fixed cost into the inventory, we have to add the $200 variable cost per unit plus the 135 fixed cost per unit. 200 plus 135 is your 335. So subtract out the ending inventory from cost of goods available for sale, you get cost of goods sold. Subtract cost of goods sold from revenues, and you get gross margin. Gross margin as opposed to contribution margin. Now from the gross margin, we're going to subtract out all of our general and administrative expenses. So we have variable marketing and fixed marketing. And these are numbers that the author has given us. All right, now you can see over here with variable costing, we have the fixed marketing down here, but the variable marketing is up here before the contribution margin calculation. So you see it's down here after the gross margin calculation. It is a little different, and the whole difference boils down to this. With absorption costing, we are going to absorb the fixed manufacturing costs into the inventory. But with variable costing, it all goes to the income statement all at once, regardless of the differences between the number of units sold and produced. Do you notice that with absorption costing, our operating income is $1.5 million? But with variable costing, it's $1,230,000. How come the difference? And the difference is because with absorption costing, some of the fixed manufacturing cost did not flow through as a cost. It's remaining on the balance sheet as an inventory item. In this case, what did we do? We produced more units than we sold. We produced 8,000 units, and we sold 6,000 units. Because we produced more than we sold, some of the cost is hanging out on the balance sheet as part of the inventory. Because of that, the operating income is higher for absorption costing than variable costing. Now, in the next period, we are going to see that it's going to be the opposite, where if we sell more than we produce, the absorption costing is going to have more costs going to the cost of goods sold because we sold more than we produced. All right, that is the big difference. And that brings us to this next slide. You can see with this next slide, we have variable versus absorption. All right, and in this case, we don't have them side by side, but we have them on top of each other. Variable costing is at the top. Absorption costing is at the bottom. Now, column B and C are basically what we looked at in the prior slide. For variable costing, if you recall, we just finished this. The operating income was $1,230,000. But with absorption costing, the operating income was $1.5 million. Now, in year 2018, which is the next year, we have some different amounts here. With 2018, we are seeing that the sales are 6,500 units. So if we take 6,500 units times $1,000 per unit, we're going to see with 2018 the revenue is $6.5 million. It doesn't matter if it's absorption costing or variable costing. Remember, we ended up with ending inventory of 2,000 units in 2017, and they were $200 each. So the ending inventory of 2,000 units for 2017 times $200 of $400,000, guess what? That's the beginning inventory for 2018. So you see the 400,000, you can see I'm circling my cursor, is the beginning inventory. Plus, since we're dealing with variable costing, all of the variable manufacturing costs. In 2018, we produced 5, and this was given to us in your textbook. For 2018, we actually produced 5,000 units. So you can see with 2018, we sold 6,500 units, but we're producing 5,000 units. So if we take the 5,000 times your variable manufacturing cost of $200 per unit, which we calculated in 2017, so beginning inventory plus your variable manufacturing cost gives you cost of goods available for sale less ending inventory. Your ending inventory for 2018, according to your textbook, is 500 units. So if we take 500 units times $200 per unit, you'll get $100,000. So cost of goods available for sale less ending inventory gives you cost of goods sold. And then because we're dealing with variable costing, we're going to add our variable non-manufacturing costs, which are $185 per unit, which is consistent from prior years, times 6,500 units sold. That gives us 1,202,500. If we take our sales of 6.5 million, subtract out our two variable costs, variable manufacturing costs, variable non-manufacturing costs, you get contribution margin. And from your contribution margin, we will subtract out our fixed manufacturing costs and our fixed non-manufacturing costs. You can see they are exactly the same as the prior year. That's the whole idea. Fixed costs remain the same in total, regardless of activity. And that will give us operating income of $1,537,000. Compare that to absorption costing. Remember, the whole difference is with absorption costing, we are going to absorb all fixed manufacturing costs into the inventory. So we're going to start with beginning inventory of $670,000. That's the ending inventory of 2017, by the way, $670,000. We will add in our variable manufacturing costs, which we stated earlier, $200 per unit times the number of units produced, which was 5,000 units, or $1 million. And we're going to allocate our fixed manufacturing costs. Remember, we're going to allocate using $135 per unit. That remains constant from the prior year, times the number of units produced, 5,000. That'll give you the 675,000. Beginning inventory plus additional cost, variable manufacturing, and fixed costs per unit. We add that all up. We get cost of goods available for sale, 2,345,000. And we will subtract out our ending inventory. Remember, our ending inventory is $335 per unit. That's the $200 per unit for variable manufacturing cost and $135 per unit fixed manufacturing cost. There's your 335 times ending inventory of 500 units. That's where you get your 167,500. And then we are also going to adjust for the production volume variance that we learned in the prior chapters. Okay, the 405,000 production volume variance, and you can see it down here. It's going to be the budget for the fixed cost. Remember, that's $1,080,000 minus the fixed overhead using the budget, which is $135,000, and we're going to actually show that adjust it for actual output. Okay, so we have the budget, which is $1,080,000 minus $675,000. How do we get the $675,000? There it is up here. You can see it. The $675 is basically the $135 per unit. That is the allocation method times actual production. So we're taking the budgeted rate times the actual production of 5,000 units. So the $1,080,000 effectively is right here. The $675 that we're allocating to the cost of goods sold, and the $405 which we are adjusting. If you add the two, you still have the full $1,080,000. We're just going to show it in two different places. Okay. If you add up the cost of goods available for sale less the ending inventory and adjusted for the production volume variance, which is unfavorable, so it's going to add to the costs, you get $2,582,000 as your cost of goods sold. Subtract it from your revenues, you get gross margin. From your gross margin, you're going to subtract out all of your non-manufacturing cost. That would be the variable marketing, which is $185 per unit, times the number of units sold, 6,500, and your fixed marketing costs, which the author gave us. You can see in year two, in year one, remember, the operating income was higher using absorption costing than variable costing. In year two, it's the opposite. You can see the operating income is higher using variable than absorption. The reason for that is because we sold more units than we produced. If we sell more units than we produce, the absorption costing net income is going to be lower because we are absorbing all of that cost into the cost of goods sold for the fixed manufacturing cost is being absorbed into the cost of goods sold. All right, so that's basically what you need to understand how that works. This is the slide that kind of puts it together. Since we're on the subject, let's just stay down here for a second. You can see I'm circling it. How do changes in inventory levels affect operating income? When production equals sales, meaning when we sell the same amount of units than we produce, the variable costing net income and the absorption costing net income are going to be the same. When we produce more than we sell, meaning because we produced more than we sold, we're going to have extra inventory items on the shelf at the end of the year. And remember, on that shelf, some of the fixed manufacturing cost is on that shelf, meaning it's on the balance sheet. Therefore, the operating income is going to be higher for the absorption costing, because remember, the fixed cost remains with the inventory. And if it's still sitting on the balance sheet, still sitting on the shelf, it didn't flow through to the income statement just yet. But the variable costing, it'll be lower, because remember, with variable costing, the fixed overhead automatically goes to the income statement in the year that we pay for it. So there's no allocating it to the actual overhead. And the opposite is true when production is less than sales, meaning we sold more units. That means more cost is going to the cost of goods sold for absorption costing. Remember, the fixed cost remains and moves with the actual inventory items. But with variable costing, it's the opposite. Okay. Are fixed cost inventoried? Meaning, do they stay with the inventory? For absorption costing, yes. Variable costing, no. With variable costing, the fixed manufacturing costs automatically flow to the income statement as an expense. Is there a production volume variance? There would be for absorption costing, but not variable costing. All right, so this is an important slide in kind of putting together those yes and no's and higher and lower, so you understand how this all works. Now, what do companies use? You might be asking, why do we go through all of this trouble? Well, like I said, for internal purposes, variable costing works pretty well because this contribution margin is very powerful, especially when we're doing CVP analysis, as we saw in prior chapters. Remember, CVP analysis, cost volume profit analysis. So variable costing is good for internal analysis, but remember, absorption costing is required for financial statement GAAP purposes, meaning the fixed all manufacturing costs, whether variable or fixed, stick with the inventory, flow through the inventory accounts, and will not show up on the income statement until it's actually sold. That is the big deal between these two. And these next slides basically explain to you what I have been explaining to you. Absorption costing, it's cost effective, it's less confusing. The reason why it's cost effective is the financial statement model for most companies have been established with absorbing the fixed manufacturing costs through the inventory. So it's already set up. It's cost effective. You don't need to set up a whole entirely different accounting system for variable costing. All right, and it's certainly less confusing since accountants already are including it for financial statement purposes. It helps prevent managers from taking actions that make their performance measure look good, but that hurt the income they report to shareholders. Right? It makes sure it doesn't produce more and just keeping it on the shelf. If you produce more and keep it on the shelf, yeah, the net income might be higher with absorption costing. All right, but we don't want that to happen in the long run. You're going to see that when we do catch up with the sales, it's going to really, really hurt the bottom line. So this is something, these swings in between inventory levels and sales, it's going to prevent managers from making those decisions. And the most important thing with absorption costing, all manufacturing costs, whether they're variable or fixed. Remember, variable and fixed manufacturing costs are necessary to produce inventory. So it makes sense to include them in all of the costs of goods sold as they're selling. All right, so this is something that's important. And then we have this third, which is an extreme, and you can see it's actually in the title of your slide, extreme variable costing, where instead of using variable or absorption, the extreme variable is called throughput costing. You can see it's called super variable costing, where we're only including direct materials. We're totally ignoring labor and overhead in our calculations. And you can see here's an illustration where here's the 2 years side by side. Remember, we sold $6 million in 17, and in 2018 we sold $6.5 million. And these are the numbers that we looked at earlier, but remember, we're only going to consider materials. And remember, materials out of the $200 per unit, we're only $110. And so we're only considering materials when we're calculating cost of goods sold. and then we're throwing in all of our other manufacturing costs after the throughput margin calculation. This is something that's extreme. I don't think most companies would do something like this. So it's really a very minor aspect of this particular chapter. Okay, and the second part, which is really the smaller part and the less important part, if you ask me, of the chapter, is dealing with capacity concepts. Like, what capacity should we be, reporting our inventory costing with? All right. So remember when we took our fixed overhead in the first part of this chapter. Remember the total fixed overhead was $1,080,000. If you go back, you can check me. The fixed manufacturing cost was $1,080,000. And we calculated that was $135 per unit. Remember, we did that because we took the $1,080,000 and we divided it by the 8,000 units of production. If you took the 1,080,000 divided by your 8,000 units of production, you got the $135. Now, the question is, the 1,080,000, just doing my calculator, divided by 8,000 units is 135. Now, the 8,000 units not only was actual production, but that was our budget amount. So the question with this second part of the chapter is taking that what that denominator should be. What should that denominator be when we allocate all of our fixed manufacturing costs? Okay. Given a firm's level of spending on fixed manufacturing costs, what capacity level should managers and accountants use to compute the fixed manufacturing cost per unit? That's what this is all about. If we take the $1,080,000 fixed manufacturing costs, what denominator should I use in trying to come up with the fixed manufacturing cost per unit? And that's called denominator level capacity. Well, there's really 4 ways we can decide to allocate our fixed manufacturing costs. One is called theoretical capacity. Number 2 is called practical capacity. Number 3 is normal capacity. And number 4 is master budget capacity. Theoretical capacity is basically when we are producing at full efficiency all the time. As an example, if we are running the assembly line without any breaks, without any breakdown, without any maintenance time, without any stoppage, without any wasteful time at all, that is theoretical capacity. That is the top amount we can possibly produce in this particular organization. In the real world, if you think about the way I've been stressing this, it's unattainable in the real world. We all know we're humans. We all know machines break down. We all know the human assembly workers, make mistakes. We all know there are shutdowns. So that's probably not the best way. Number 2 was practical capacity. Practical capacity is the level of capacity that will reduce the theoretical capacity by considering unavoidable stops, maintenance time, vacations, and things like that. It basically measures what a plant can supply, and it's more realistic than theoretical capacity. All right. Once again, it's okay, but it's still probably not the best way. Now, normal capacity is where we are producing to satisfy average customer demand. Now, the key word there is average, right? Average customer demand over a period of time where we consider seasonal cycles, cyclical cycles, trend factors. We have enough time period where we're figuring out an average over all of those ups and downs. And then last but not least, we have master budget capacity, where we're basically considering the master budget for a year, for 1 year. Obviously, in 1 year time, we may not have all the cycles and the trend factors as normal capacity would. All right, so those are the 4 ways that we could figure out the budget capacity, or I should say take the $1,080,000, which is the budgeted fixed cost, and divide it by a denominator with theoretical capacity. If I keep going without stopping, 18,000 units. Practical capacity, where we're considering stoppage, 12,000 units. Normal capacity, where we're calculating average customer demand, 10,000 units produced. And magic budget capacity, this is the one we used for our studies here in this chapter. Remember, we used 8,000 units. That was our budget, 8,000 units. And that's how we got the $135 per unit for manufacturing costs. Typically, for financial statement purposes, we would use normal capacity utilization, but certainly this is something that company needs to take a look at. But for financial reporting, normal capacity is typically used. So choosing a capacity level, like I said, it depends on what we're looking at. External reporting typically being the key factor here, at least for me, being an accountant and looking at financial statement prep. But this is something that we would need to take a closer look at. And what is our purpose? Is our purpose product costing? Is our purpose capacity management, pricing, performance evaluation, external reporting, tax requirements? So certainly you would need to go through this for product costing and capacity management using a practical capacity. All right, that is where we consider the total amount we can produce, considering some breakage in time because of maintenance time and downtime of holidays and things like that. Something we would consider. For pricing decisions, this is something that we would need to know. Practical capacity is probably used. It's a more stable measure, so it should help us mostly with pricing decisions. Performance evaluation. Once again, what do we want to look at? Well, with performance evaluation, unused capacity adds costs. Mid-level managers really have no control over those costs, but they do have control over prices. So these are questions we need to ask ourselves. What do we want to use when we're evaluating performances? So that's something you want to consider. For financial reporting purposes, like I said, typically we are going to use normal capacities. But we're still going to have that production volume variance with financial reporting. So the total fixed cost is going to be reported somewhere on the financial statements. It's just a matter of how much get included in the ending inventory and how much are reported as a production volume variance. All right, and so that's something that we need to consider as well.